It's GDP growth. It's full employment. It's earnings growth. It's the promise of an administration that will lower taxes, cut regulation, and empower companies to find cheaper oil, which is a tax cut for everybody, right? I'm still all in on stocks.
The market continues on an upward trajectory. I'm your host, Andrew Brill. We'll talk about where it's going and what to expect in the near future. I'd like to welcome back someone who I always enjoy talking to, Adam Johnson, who is the portfolio manager of the Bullseye American Ingenuity Fund and author of the weekly Bullseye Brief, which is an investor's newsletter. Adam, welcome back. Glad to see
Thank
you
you,
again.
Andrew. Yeah, we got a lot to talk about today, so I'm very glad to be with you.
Well, I know that last time we spoke back in September, you hit the nail on the head, but we'll get to that and we'll talk about that. But I want to get your take. We have a new president. We have, uh, you know, not unexpectedly, because as James Carville said, I think during the Clinton years, it's the economy stupid, and I think
Yeah.
that a lot of people voted with their pocketbook and with how they're actually doing. But I want to get your take on the present economy and where you think it's headed.
Yeah, well, let's start with the economy because that's ultimately what it boils down to. As you point out, right, James Carville, it's the economy, stupid. GDP is growing. It's growing somewhere between 2.5% and 3%. That's consistent with the long-term average. So that baseline is very positive. We also have very strong employment. There are a lot of people working. Granted, there have been a few more who've been laid off over the past several months, but unemployment is down around 4%. That's extremely low, which is good because when people are making money, they are spending money. And when they're spending money, that's generating sales for US companies. And that's why we see earnings growth of somewhere between 8 and 10%. And I think actually that's going to accelerate into next year. I think we're going to see 10 to 12% earnings growth. So the macro backdrop is very positive from all the stuff we can actually measure, and then there's the stuff we can't quite measure, like what's happening politically, and very positive in that we now have an administration that is likely to cut taxes, an administration that is likely to cut regulations, and an administration that is likely to unleash drilling on federal land that makes cheaper oil more available. So all that stuff, even though we can't quite quantify it, that's directionally positive. So you add the stuff we can quantify with the stuff we can't quite, but we kind of think we can, and that argues for being long stock. So I'm fully invested. I've done some more buying since the elections, and I think we're going to see a strong run up into year end.
Yeah, I know that it's interesting you say that the GDP is growing. Are we worried at all that it's growing at that rate because of government spending?
Okay, so that's a very interesting point, Andrew. There's all this talk about Elon Musk and Vivek Ramaswamy coming in and slashing inefficiency in government. And that will inevitably lower government expenditures. And yes, you're right. Government expenditures are about a quarter of GDP, gross domestic product. So, there is this notion that, hey, wait a minute, if the government stops spending enough, it actually could slow GDP growth. Yes, that is an absolutely fair argument. But I would also argue that that's going to be offset by what I think will be tax cuts. And that means more money for people to spend. And actually, 2/3 of GDP is personal consumption. People going out and buying stuff from cars to houses, clothes, dinners out, insurance, doctors' expenditures, et cetera. So if the government is a quarter of GDP and the consumer is 2/3 of GDP, by definition, the consumer matters more. And I think this administration is very focused on doing what's best for consumers. So yes, you raise a valid point about not wanting to cut government spending too much, but I think there's a far larger offset on the consumer side.
Interesting, you had mentioned unemployment. I was reading this morning that first-time unemployment claims are down,
Yep.
lowest level since back in May. So that also plays into getting money into consumers' hands, because if there's less unemployment, that means there's more people working, more people able to spend money. GDP should continue to grow, as you had pointed out.
Yeah, yeah, exactly. And while all of us enjoy talking about politics and political outcomes, what ultimately matters most is earnings. And obviously, for me as a portfolio manager and for my clients as people who are invested and at this point fully invested. So yeah, you just connect all these dots, and it's all about earnings and earnings growth. And some of the big themes, artificial intelligence wouldn't exactly be a surprise to anyone. But it's not just buying Nvidia; it's buying companies that create power. It's even utilities, are suddenly finding a bid because they're the ones who have to supply power for the data centers where all these computers powered by NVIDIA chips are operating and consuming a great deal more electricity. So, it's also a company like Dycom, ticker DY, just a good old industrial that helps actually build data centers. It's like the data centers themselves that you need, right? There's this whole multiplier effect, not to mention the fact that every company is trying to figure out how to become an artificial intelligence company. Just as 10 years ago, every company had to figure out how to be an e-commerce company. And 5 years ago, every company had to figure out how to be a cloud company. So there are these big thematic movements that are creating very strong reasons to invest. And that's what I'm trying to tap into as the portfolio manager of the American Ingenuity Fund.
It's interesting you mentioned power. I've asked a bunch of people about nuclear power, which here in the United States, we kind of, because of nuclear waste and all this stuff, I think there's been some massive advancements here. Is nuclear power something we should be keeping an eye on? Look, Microsoft went and bought 3 Mile Island, and
Right.
that's not far from where I grew up, and I remember some of the problems that we had there. But is nuclear power something that the United States, here in the States, will start getting back into?
I think so. I think the answer is yes, that we will start relying more on nuclear power. The thing is, it's a very hard theme, nuclear energy. It's a very hard theme to invest in because these plants take years to permit and then build. So it's not as though you can buy a stock that has exposure to nuclear and say, well, things should kick in by next quarter. I mean, probably not. And you hope by next year or the year after that or the year after that. Now, some of my stocks are long cycle stocks that I intend to own for many years. If I'm right, they will double and triple earnings every few years, and the stocks will, follow higher. But yeah, nuclear is a very, very hard theme where you can try to make money. It's a lot easier to make money in oil because there's so many oil stocks. But the irony is that we may be going into a golden age of production, right? If the Trump administration loosens drilling on federal land, there'll be access to more wells. But more access means more supply, which
Right.
will lower the price. And that's not necessarily good for the earnings of oil companies. So don't buy an EOG, the greatest producer out there, or Chevron, I think the best run major, simply because there's going to be more oil production. It might actually hurt them in the long run. What you could do is buy an oil services company like a Halliburton or a Schlumberger, though I prefer Halliburton, because those guys are paid to go in and drill on behalf of the companies that are producing it. So I would bet on service companies, but I wouldn't bet on producers because I do think we'll see lower oil prices, which again is good for consumers, and that's good for the economy and the market as a whole.
Are you concerned about your financial future or think your investments could be doing better? I'm Andrew Brill, one of the hosts here on Wealthion, and I've been there. Not sure my money was in the right places. It's why I've gotten help from a financial advisor. Maybe it's time you think more about your financial future or get a second opinion about your investments. We've made that process easy. Simply go to wealthion.com/free to speak with one of Wealthion's registered investment advisors for a free, no obligation portfolio review. Again, that's wealthion.com/free. I'm now less anxious and confident I can achieve the financial goals I've set for me and my family. And while I have a minute, I want to thank you for sending us some of your Bullseye briefs. And I want to tell everybody, if you haven't read it and don't subscribe to it, take a chance, read Adam's Bullseye brief, because the research is phenomenal. The hints at what you might be able to buy is phenomenal. And he'll even give you a look into his own portfolio and what he's watching. And it's got a wealth of information. So the Bullseye brief, Adam, again, thank you for
Thank you.
sending that to us. And it's really a wealth of information. Now, last we spoke back in September, and you were all in on stocks, and you hit the nail on the head. Stocks have gone up tremendously. We were embarking on a rate cut at that point, 50 basis points. We've now lived through another 25 basis point cut. And the inflation numbers seem to have stuck where they were. Do you see
Yeah.
more cuts coming? It seems like another 25 basis point cut is coming in December. Maybe I've read stuff that they may pump the brakes on that a little bit. But where do you see rate cuts coming? I know the new administration wants to goose the Fed a little bit to bring interest rates down, but where do you see it going from here?
So I see another couple rates in the future. And I'll tell you why. I only see a couple and not more. So if you remember, a year and a half ago, producer prices at one point peaked at 11.3%. That's sobering, right? Consumer prices peaked at 9.1. So 9, 11, call it whatever you like, the Fed's target is 2. So the Fed had to raise rates from effectively 0 up to 5.5% just to try to clamp down on inflation. Well, the good news is inflation has effectively come down to somewhere between 2 and 3%, depending upon how you want to measure it, whether it's CPI, PPI, GDP price index, or personal consumption expenditures. Those are the 4 measures of inflation. And in fact, if you average the 4 together, they're 2.2%. All right, so we were as high as 9 to 11. We're now at 2.2. The Fed's target is 2. We're almost there. So it would make sense that the Fed would take back some of those rate cuts that went as high as 5.5. They took back 50 on the first round. They just took back another 25, right? So now we're at 475. In December, I think we get to 450. Okay, then we get into next year. It probably makes sense as long as inflation stays down where it is. Probably makes sense to cut another 25 and then another 50 as we get into the spring. And that'll get us to about 4%. But we're not going back to 0. A, because we don't need to. B, because that was inappropriate. That was simply a function of stoking the economy coming out of the lockdowns that were essential during COVID. And so the pendulum had to swing one way, then it swung the other, and now it's sort of coming back to where it belongs. And then the final component of trying to, I'll say guess, because, no one really knows, right? No one really knows where rates are going. We can make an educated guess. But the other component is that it's very possible that the Trump administration's policies, effectively cutting taxes, which gives people more money to spend, and raising tariffs, which by definition raises the prices of imports, it's very possible that those two policies could actually stoke inflation. How much? It's hard to say. We can model it. You get 10 economists around a table and you'll get 10 different answers. So you sort of triangulate and kind of, go with the average. But it is possible that inflation will accelerate, call it in the spring or maybe early summer when some of that stuff becomes reality. And I think it will become reality. So, yes, the Fed will stay flexible. And in fact, Jerome Powell, the chairman of the Fed, said as much at the Fed meeting that happened about a week and a half ago. So stay tuned. Yes, I think rates are going down. That's good for stocks. But, the inflation picture, while much better than it was and practically back to 2%, is something that is, like cash flow, something that, kind of moves from month to month. And we just need to be sensitive to it. And I certainly know that Jay Powell, Fed chair, is very sensitive to it because he's told us so.
And a lot of the Fed governors have spoken since that meeting, and all of them pretty much say we're dependent on the data. And if the data is showing what it's showing, then maybe rate cuts, we'll get a couple more, but they might slow after that. And, also a good point that some of the policies are inflationary. So
Yeah.
it's possible that could creep up. What about the dollar, Adam? It's pretty strong now, and it keeps getting stronger.
Yep.
Obviously, Donald Trump said he wants to weaken the dollar, but keeps getting stronger.
Well, the dollar is a barometer of confidence. I remember down at Princeton, my Econ 101 prof, Alan Blinder, former vice chairman of the Fed, the guy who convinced me not to be a doctor, but instead an economics major, and here we are. He used to talk about the macho theory of exchange rates, which was, we want a strong dollar because we're the best, pound your chest. And in fact, every Treasury Secretary going back to World War II has said we affirm a strong dollar policy. And they say that for a couple of reasons. We issue a lot of debt, And so when the dollar is strong, people are willing to buy our debt, treasury bills, et cetera, and that helps fund the government. If the dollar were weak, that would mean that there's inflation and people wouldn't necessarily want to buy our debt and interest rates would go up. So there's this kind of curious thing where you want the dollar to be strong. In the eyes of the world, you want it to be the reserve currency. That just reinforces the U.S. as the strongest kid on the block. But it does make our exports more expensive to other nations. So that too, the dollar is one of these things that you have to watch from day to day. It's not a fixed point; it moves moment to moment. It's at highs right now for two reasons: 1-year highs. One, because rates have started to percolate. They were 350 and now they're back to kind of 450 on the assumption that the bond market got ahead of itself, expecting too many rate cuts. And number two, because I would argue that the incoming Trump administration is a strong-handed, strong-armed administration, and that's good. It might mean fewer wars or fewer things to worry about, less belligerence out of countries like China and North Korea and Iran. That's positive, and the confidence in the U.S. generally tends to manifest itself in dollars. People say, there's a lot of uncertainty in the rest of the world, but there's a strong government coming in, and you know what? So we should probably put our money in dollars. It's almost a safe haven trade. So I think that's in part what's fueling the strong dollar right now.
Yeah, and I think the last University of Michigan measure of consumer confidence is up, so that's also a good sign.
Yeah.
So, what about earnings, Adam? We're in the middle of earnings season. I know that Disney just came out; their streaming business is profitable now, which is obviously a change. I know that the Ingenuity Fund has Disney in it.
Yep.
Nvidia is coming out next week as we record this, actually on Thursday. But Nvidia is coming out next week. What have you seen with earnings season? Any surprises? Anything that we should be worried about?
Well, earnings, I thought were going to grow double digits this past quarter. The third quarter reporting season that's pretty much over now. Turns out they didn't, but they still grew 6, 7, 8%, sort of on average, which is consistent with the previous 2 quarters. So we've now had 3 quarters in a row of growth that's somewhere around 6, 7, 8%. That's good. It can be better. There's room for improvement, and I think we will see improvement up to double digits when we get into the fourth quarter reporting season, and that will happen starting about the third week of January. I think we'll see an acceleration of earnings into the spring, and so whereas earnings for the S&P 500 are probably going to be around $250 for 2024, I think they're going to accelerate to $280 to maybe $285 for 2025. That's positive. That's the sort of 10 to 12% earnings growth that I am modeling, and I think many on the street are modeling, and it's why people can justify going out and buying stocks at what is not an expensive multiple, but certainly a relatively optimistic multiple. The S&P is trading right now at about 22 times earnings. The average for bull markets since World War II, well, no, let me say the average for bull markets since 1990 is 17 to 22 times, maybe 23, when you figure in periods when rates are coming down. So if we're at 22 and the average is 17 to 23, we're getting to the point where you start to say, all right, that's, a robust valuation. If you then make the jump to, well, but hang on, does it mean that we're close to a bubble? I'd say no, not even close, because in 2008 and 2002, we saw the S&P go anywhere from 40 times to 70 times. So we're still a long way from there. So no, we're not in a bubble. You just have to recognize we are getting to a point where markets are pricing in 10 to 12% growth. And I think it's important to be a stock picker. You can't just blindly buy anything. That was last year. You could have bought anything and it was going to go up. And thank goodness, because, in 2022, markets were down 30 to 35%. So now you really have to be a stock picker. You got to know your companies. You got to know the earnings growth. And you've got to focus on quality. And that's what I do. on behalf of my subscribers. I tell them I'm doing the work that they don't have time to do, and saying here are the 40 names we want to own.
And if you don't follow Adam on Twitter, you should, because that S&P analysis that you just gave me was in. You did tweet about that, and I was wondering, back in June also we had a guest who said, "Oh, the S&P is going to hit 6,000," and I was like, "Really?" Because at that point, it was I think about a 15% increase from where it was, maybe a 20% increase from where it was, and I was amazed. But he was
Yeah.
dead on. It hit 6,000. You think and it's not in a bubble. You think the S&P continues to grow?
Yeah, I do. I mean, just, put a 22 or 23 PE multiple on earnings of 280 or 285 bucks, and you get to somewhere around 6,300. So, I think the S&P can continue to rise. And then you say, "Oh my gosh, but Adam, what if it gets to 6,300? Do you sell everything?" I say, "No." But at that point, we become very discriminating because, if the S&P 500 goes up and sort of hits its target, it probably tends to sort of trade sideways. Now, individual stocks, can continue to go up, but what you have to recognize is if the market's fully valued, you no longer have that tailwind. So you do have to be particularly aware of your own companies, and you could even make the argument that if you get to 6,300 and and then, as we've seen over the past week, some of the names pop 10, 11, 12% on great earnings. It's okay to sell a little bit. Maybe you say, "You know what, we're gonna put 10% into our pocket." If we're 100% invested, just sell 10% of every single position. Put a little cash in the pocket. There's nothing wrong with having a little cash when the market's fully valued, and so if it pulls back, you can redeploy it. But I also want to be clear: I don't think we're there yet. I am fully invested. I do think the S&P is going to rally into year end. I do think it will get up to 6,300 in the near term. I mean, we're at 6,000 now, so
Right.
another 5% isn't exactly a bold call. But I do think about whether I want to take a little money off the table in some of my names. I mean, Coinbase, which is my proxy for crypto, was down around $100 not long ago. It's over 300. Nothing goes up forever. We still have all our shares in Coinbase, but there may be a point at which I'll look at my Coinbase and say, this thing has tripled in like 9 months. You know what? Sell 10%. So that's part of my calculation that will happen as we approach year end. But for now, I'm still fully invested.
And I like your philosophy of taking some money off the table. And again, in the Bullseye Brief, you lay it out for your subscribers. Hey, look, at this price you should buy a little more, and at this price you should take a little bit off the table because
Yeah.
it may continue to grow, but it may not. So take some off the table, take some profits, maybe take your initial investment out of it, and continue to let it ride. So great advice and a great investment strategy.
Yeah, thank you. Well, every person has a different sort of chemical makeup that causes you to respond differently to good news and bad news, and risk is a part of that. So I have clients who have, as a buddy of mine who's a Navy pilot likes to say, no apparent fear of death, and and they just want to be long stocks 100% of the time. And if the market trades down, they'll go on margin and borrow more to buy the dip. I have other clients who say, "Well, I've made all this money. I don't want to lose it. I still want to grow, but I'd much rather just have most of my money in safe dividend-paying stocks or bonds or even government bonds, knowing that I'm going to earn 4 or 5% per month, and it lets me sleep at night." Totally fine. I get it. Most people have a little bit of each of those two sort of inclinations, and that's good too. You want balance. So as I say, we all have different personalities, different chemical makeup, different risk tolerances, and different ways of approaching how we like to manage our money. And the key is knowing who you are as a person, and then finding someone who can help you recognize that vision. Or if you're lucky enough to be able to do it on your own, do it on your own.
So, Adam, when last we spoke, you were all in on stocks. We hadn't started to cut rates yet, and a lot
Right.
of that was baked into the market. Are you still all in on stocks? Sounds like you're still all in on stocks. Are you
Yeah,
still all in on stocks?
I'm still all in on stocks. I intend to maintain my 100% invested uh, approach for the coming weeks and months. And maybe somewhere in the first quarter, um, as the market continues to rally, I'll sort of wake up one morning and say, all right, let's just lighten up a few things. But we're not there yet. I'm all in for the moment.
So is it earnings that's driving the market? Is it hope for the future because we have a new president? What exactly is driving the market at this point, do you think?
All of the above. It's GDP growth. It's full employment. It's earnings growth. It's the promise of an administration that will lower taxes, cut regulation, and empower companies to find cheaper oil, which is a tax cut for everybody, right? If gasoline
Right.
goes down and oil being an import for virtually every product out there. So as I tell people, there is a lot more to like than to fear. Yes, I know there are wars happening right now, from what's happening in Israel to what's happening in Ukraine, and that's unsettling. Yes, I know there is belligerence coming out of Asia, specifically China and North Korea. They're unpredictable, and we don't exactly know where any of that's going, especially Chinese aggression towards Taiwan, which produces two-thirds of the world's semiconductors, right? So, there's some unsettling things out there that we can't quantify, but there are always unsettling things out there that we can't quantify. So, what you have to do is look at what you know and determine whether you're comfortable with what you know and what the glide path would appear to be based upon what you know. And for me, that is 3% GDP growth, 4% unemployment, 10% earnings growth. Those are hard numbers we can quantify. That argues for being long stocks. And add to that what we've talked about from the Trump administration about lower taxes, fewer regulations, and drill, baby, drill. And that is a very powerful tonic for being long stocks.
It's interesting. They always say the stock market isn't the economy, but it is a reflection, I believe, on the economy. When Trump
Sure.
first took office, the Dow was about 20,000. When he left office, it was 30,000. And now it's around 42,000. Adam, is this sustainable? Is this going to continue? Now Trump is back. So, you
Yeah.
got a nice 33% jump from the first time he was in office. I don't think we can expect that, can we?
There was a time, Andrew, when the Dow was 100, and then it went to 1,000, then it went to 2,000. And so whether it's at 40,000 or 41 or 42, there will be a time when the Dow's at 60,000. There will be a time when the Dow's at 80,000. There will be a time when the Dow's at 120,000. I don't know how long it'll take to get there, maybe 40 years, maybe 50, but the good news is that growth happens over time, and you would much rather be exposed to growth than not. Stocks rise 2 days out of every 3 days. So I always tell people think about time in the market, not timing the market. Now, if you need money next month or next year because you're retiring or you have a big purchase, fine. Sell stocks because in the short term, markets are volatile. They go up, they go down. But if you look at markets overall across broad swaths of time, 3 to 5 years, they tend to rise. And they tend to rise on average somewhere around 12%. That's pretty good. So if you do nothing, if you're 30 years old and you just put $1,000 a month into an S&P ETF or a triple Q's ETF, $1,000 a month, you're saving 12,000 a year, and that thing compounds at 12%. You're doubling your money every 6
4 years.
years or so, and you're adding more money to it. So all of a sudden, you started doing this $1,000 a month at age 30, and by the time you get to 65, you say, "Holy cow! I've got
Right.
several $1 million in the bank, and all I did was save $1,000 every month." But you did it every month for 35 years, and that's the way to approach long-term investing and creating long-term security.
I think there was a light bulb that just went off on some of our viewers, some of our viewers' heads saying, "Oh wow, only $1,000 a month, and that's where I can end up." And I hope that's exactly what happens. But
Yes.
I think that my grandkid will sit here interviewing your grandchild and say, 120,000 on the Dow. Where is this going from here? So I think your point is correct. Adam, what are we watching these days? What sectors are we looking at? We know that there's a new regime coming in, a new president coming in. I shouldn't call it a regime. It's a new president coming in. What
Yeah.
sectors are we looking at?
Well, actually, I would use the word regime, not for the president, but an investment regime, right? Where I think we're going to have a very attractive backdrop for stocks. If you want to talk about groups or sectors that play into a Trump administration, focus on defense and border security. A company like Aero Environment, I don't own it, ticker AVAV, but I'm looking at it. They make drones that just hover back and forth. That's one way to protect the wall. Certainly, we're learning that Ukraine is using drones against Russia in its war. A Lockheed Martin plays into that. So certainly, security and border security and a strong military, that's a Trump kind of thing. If you want to talk about deregulation, not just banks, the obvious beneficiary of that, but sort of new finance companies like SoFi, right, which was the first ever bank designed from the ground up to be internet only, or a company like Block or Square, if you remember, a PayPal. Companies like this that are in digital payments, a Coinbase. The Trump administration appears to be crypto friendly. So lower regulation in the financial sector argues for owning financials. Fewer rules on drilling argues for owning the service companies. As I said though earlier, don't buy the producers because lower oil means they might actually make less. So there are a number of different sectors that we can talk about. Artificial intelligence, we've already talked about. Core Ingenuity, I think you need to own, like Salesforce, like Palo Alto Networks for security, the Magnificent Seven, right? I mean, there are a lot of names to own that are very exciting. I don't think consumer staples, are very exciting. I wouldn't be buying, companies that produce food. That's kind of boring. Agricultural stocks, you're at that point, you're just betting on the price of corn going up. That's not particularly compelling or exciting. Railroads, not particularly compelling or exciting. Buy stuff that's growing, right? That where companies are creating new products or they are levered to growth in a more macro sense. That's exciting. That's where I'm deploying money for people.
And when I speak to economists, they're ringing the bell. They're saying recession's coming, the world is ending. But when I speak to you, who is a stock picker, everything is exciting. Everything is great, and the market's doing really well. Should we worry about a downturn? Should we be trying to protect ourselves a little bit?
There will be a downturn at some point. I can assure you there will be a recession at some point, but that point is not anywhere in the near term. So no, I understand that there are people who like to worry. I understand that there are other people who like to hear about people who are worrying because it makes them feel like they're being smart and they're getting ahead of something. And bears always sound smarter than bulls because skeptics might see something that we don't. All of that is absolutely fair, and I get it. But I just see a lot more to like right now than to fear. So the short answer to your question is no.
Human nature, we all want to see sort of the little dark side of certain things, even though we should be saying, no, this is great. Heading into Thanksgiving and then the end of the year, a lot of people sort of take some time off. What are we looking at? What should we be taking care of towards the end of the year?
Well, take care of your tax situation. Recognize that there may be some changes coming up next year. If you haven't already put money into your 401k or your IRA, do that. You've got till year end, and that's the best way to build wealth because the government's giving you a tax break to do it. Put together a budget for next year and think about where you want to spend money, where you want to invest money, where you want to invest your time. Think about what matters from family to security to financial security. I think year end is always a wonderful time to think about where you want to be and set some goals for next year. I certainly do it in my business. I do it in my personal life. And I think it's just a healthy exercise that we can all do. And, it doesn't take that much time. You can just think about these things on long walks, and it starts to take shape. I remember Daniel Kahneman won a Nobel Prize for some of the work he did, and wrote a wonderful book called Thinking Fast and Slow. There are times when you need to think very quickly. Do you want to buy the stock right now? It's on the move. Do you buy it? Or there are times when you say, let me get back to you on that. And being able to toggle back and forth between thinking fast and thinking slow is very healthy. And I would invite all of our viewers and listeners to think about how they can think fast and slow, and improve their decision making incrementally for next year.
And you said Coinbase is your crypto sort of ETF. What do you think about crypto at this point? I know that the new president is pro crypto and stuff like that. Obviously, deregulation would help that. What do you think of crypto at this point?
I've never owned crypto, but I do like Coinbase, and it's my proxy for the whole sector. I don't know if our viewers necessarily realize that BlackRock, the largest money manager in the world, has a joint venture with Coinbase, such that when any of its clients, institutional or individual, need access to crypto markets, Coinbase handles it for them. So Coinbase is, effectively the go-to arm for the go-to money manager of the world. That's a pretty strong endorsement, and it's one of the reasons why I'm long it.
And it's if you individually, if you want to buy a cryptocurrency, that's where you go to do it for the most part. That's where I did it.
Yeah.
I didn't invest a lot, but I had to get in on it. As you say, you see things going up, and you have to get in on it. It's another interesting thing I read, and everybody's timing the market. You're saying, well, if something hits a new high, take a good look at it, because chances are it's going to hit another new high.
Yeah, yeah. New highs beget new highs. Momentum is powerful, and this is a momentum market right now. There's still people sitting on the sidelines. It's not too late to get in. That's why I'm fully invested. But yeah, just embrace it. People always feel like if something moved and they didn't get the bottom, I missed it. No, you didn't miss it. Go buy it now. No one is smart enough to buy the bottom and sell the top. So I'm generally very happy to make the middle 80%. I'll miss the first 10, and I'll probably miss the last 10, but that middle 80 is very powerful.
Last thing, I was reading your newsletter, and as a kid, I used to watch the Jetsons, and when I read about Joby, I was like, this is right out of the Jetsons.
Oh, yeah.
But this is a stock that you're keeping an eye on.
Oh, I love this one. $5, $6 stock, actually. Joby Aviation, JOBY is the ticker. This is the leading company right now for the new market, whereby they are going to create air taxis, drones that carry 5 passengers. They have 6 rotors. They're very quiet because they're electric powered. They fly at about 150 miles an hour, and they're initially going to be used to transport people from city centers to airports. They're going to debut in Dubai. They're building the first terminals right now. They're going to debut in Dubai the middle of next year. The Air Force is already testing them. They're really cool. I think Joby is going to be the Uber of the skies, and it'll transform how we move around. I mean, think about it. You can take an Uber from Midtown Manhattan out to JFK Airport, and it costs about $90 and takes sometimes an hour and 15 minutes.
Right.
Or you'll be able to go to the 33rd Street heliport on the East River, jump in one of these drones. They're so quiet that it's the sound of rustling leaves, so you barely even hear them, so they're not a nuisance. And it'll fly you to JFK in approximately 7 minutes for the same price, about $100. It'll land. They can recharge within 5 to 10 minutes. And then return. They'll go back and forth. Ultimately, it'll be more than just getting to and from the airport, because the range on these things is about 150 miles. So I think you'll see short haul travel all over. In fact, one of the other markets is going to be Newport Beach to LAX for our West Coast listeners. So it's very exciting. Joby, $5 or $6 stock, very well capitalized. Partners include Delta, Toyota, South Korea Telecom. I mean, it's really exciting. Intel, very exciting what's happening at Joby, JOBY.
I looked at it, I said, well, this is the future of not only travel, but owning a car. Someone's going to soon own one of these things that can take
Yep.
them from New York City out to the Hamptons, or,
Yeah.
to go a certain distance in a lot less time with that traffic.
A lot less time.
Adam, where can we find you other than the Bullseye Brief, which I already plugged? And I know you do your walk and talks on Instagram. Where else can we find you?
Yeah, well, the walk and talks, I post these, 45-second videos a few times a week. Instagram or Twitter at AJ Insight is my Twitter handle. Bullseyebrief.com is my investment letter. I publish every Sunday. I have a 45 day trial for $45. And I talk about all the positions, the buys, the sells for that given week, news on the names, and then I highlight a new pick or a focus pick. And the money management business is bullseyeig.com. That's Bullseye Investment Group. Bullseyeig.com if you're actually interested in talking to me about managing money, which has grown out of my investment letter. People said, I read your letter, but what if you just ran the money? So I've been very fortunate to grow with some wonderful, wonderful clients. And I'm thrilled to be able to be here with you as well, Andrew. So thank you.
Absolutely. Adam, always great to talk to you. I love our conversations, and have a great Thanksgiving, and we'll have you back soon.
Great. Thanks, Andrew.
Thanks so much for watching our discussion here on Wealthion with Adam Johnson. Adam always has a hidden gem or two that he lets us know about. If you're looking for some of those hidden gems or in need of help being financially resilient, please head over to wealthion.com/free for a free no obligation financial review. And of course, if you could like and subscribe to the channel, we would greatly appreciate it. Don't forget to hit the notification bell so you know when we post new videos on the channel. And please do the social media thing with us. All the links are right below in the description. And if you like the content and are looking for more ways to achieve long-term wealth, watch this video next. Thanks again for watching. Until next time, stay informed, be empowered, and may your investments flourish.